Star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hey, what's up, y'all? Thanks for joining the first installment of the new Options Millionaire How-To series. So as we've gotten deeper into this community and deeper into education and community learning, I've realized there is a gap for the beginners. As I go back through all my content and as through the feedback from my members, I realized that the very beginner options traders that come into the market that are brand new don't really have a place to learn, and they learn the real basics. I've got a few basics options trading videos, but nothing really in depth. And instead of making one really long, 1 hour long how-to video on how to options trade, I thought I would create a how-to series to lay out step by step from the first time you enter the market as an options trader until you've finally been here for a while, you kind of get the hang of it and start to get into more advanced theories. And that's kind of the way we're going to roll. And the next few months, I'm going to pivot to a more basic educational series and go deeper into that. And every now and then I'll toss in an advanced strategy or a trading recap video to go over a couple of different strategies. But we're going to get started, and we're going to kick the how-to series off today with how to pick a strike and expiration. There are two different main types of trading that we think of when we actually start day trading. There's stocks and there's options. Obviously, there are a number of other things you could do, but I'm just going to keep it to the basics here, stock and options. As a stock trader, when to buy or how to buy is usually pretty obvious. You buy low, you sell high. What to buy? For example, if you want to buy SPY, you just go buy SPY. You buy 1 share, 2 shares, 10 shares of SPY, and you sell it when you want. You sell it whenever you think that you're going to get your profit out of it, or it's not going to go any higher, and you sell. Easy peasy, lemon squeezy. However, for the first time, for the beginner, going into the options chain for the first time on whatever broker you use, I'll be using E-Trade myself, can be very daunting. You open up Power E-Trade or whatever broker you use, Webull, and you bring up the option chain for the first time, and there's numbers everywhere, seemingly endless amount of data, numbers, random colors, and you don't really know what to buy. You've got something called the bid ask, you've got premiums, you've got the strikes, but you don't really know what that is. Why do I have all these different strikes? What does that mean? Do they expire? Do I lose my money if they don't go on the money? Like, what happens with these things? Then you start looking at all the things called delta, gamma, vega, theta, rho, intrinsic value, implied volatility, open interest. What does this all mean? When do I buy? How do I buy? What do I buy? When do I sell? Do I lose my money? Will I make money? All these questions start pounding into your head, and you don't really know what to do. So in this video, we're going to break all that down on a basic strategy on just how to pick a strike, how to pick an expiration, and what does it mean for your level of risk tolerance. All right, so I'm going to go ahead and bring up my options chain here on E-Trade. I use Power E-Trade. Now, I will preface all of this by saying this video is geared towards the long call, long put trader. If you're looking for some short strategies like short calls and puts and then riding strangles, this is not going to be the video for you. So as you can see, there's a lot of data, a lot of numbers on this screen. If you are new to trading, new at options trading specifically, it's going to be very daunting to look at this. You're not really going to know exactly what to pick if you're very new, very green. I remember when I first started options trading, I sure as crap didn't know what any of this means, and it took a lot of time to really understand and correlate all this data together to start making good, sound decisions. All right, so when you first start looking at this options chain, it looks like a lot of redundant data, a lot of numbers, a lot of zeros just plugged in there. However, once you start to learn everything, it all starts to translate, like Neo seeing the matrix for the first time. It just starts to make sense. So the right side, you've got your put section. The left side, you've got your call section. Now you see that they are shaded differently. Here's the light blue shading, and here's some dark blue shading, and here it's opposite. Well, that's because in the call side, this is in the money, and this is outside the money. What does that mean? When you pick a strike, here we go, 459, 460. The current price is 459.25, so right in the middle, right here. Anything above that, or I'm sorry, anything below that is considered inside the money, which means it's the strike is already below that price. So those contracts are already inside the money. Now on the put side of things, it's opposite because you are buying a contract hoping that SPY will go down. So it's this way. So these contracts are already safer because they're already inside the money. Your strikes are already inside the money of SPY. They're already above it because you want the price to go down. So they are opposite. Now, all that suffice to say is that these are more risky than these. These are more risky than these because they're outside the money. And these are more apt to expire worthless because they are outside the money if SPY would not move. To really dial down the value of these and identify the volatility and the riskiness of these, we need to look at the delta, starting out of the delta. You've got your premiums right here, but this right here is your delta, 0.44, 0.30, so on and so forth. The delta, and I'm not going to get into the Greeks. There is a video on my educational series called How to Read the Greeks. Highly recommend read that. It's going to be linked in the description of this video below. But the delta, summarized, is going to be the amount that your premium changes giving a $1 move in the underlying. In this case, the underlying is SPY. That's what we're trading. So if SPY were to increase $1, this premium 0.87 that's what you pay for it, will increase by the amount of the delta, 0.4456. Now, knowing this, the most common question I get is, hey, OM, why don't you trade deep in the money contracts because the delta is significantly higher than the deltas out here? Well, to the newer person, I understand how that would make sense, because a higher delta, that is going to require more money. However, you have to realize that the deeper in the money that you go, the higher the premiums get. So 848, you can see that these premiums are increasing right here, the more in the money that you get. So in order to take your rate of return or your profitability, your projected profitability in that position would be to take your deltas and divide it by your premiums. That's going to give you your percentage return, your ballpark. There is some other variables, and I won't get into it. Basically, gamma is going to affect your delta, so it is going to be a little off. But it'll give you a good ballpark number, rate of return, percentage return, if SPY were to increase by $1. For example, if you were to take this delta, 9662, and divide it by 848, the rate of return here, the percentage return you would make is 11.4%. So you would profit 11.4% roughly if SPY were to increase $1 by buying this premium. So let's look at this one, right at the money contract with a delta of 44. It's less than half, or it's more than half of this delta, but what's going to be the rate of return? So we take 0.4456, we divide it by 0.87, and we get a 51% return. So if SPY moves $1, then we make 51% of our money. Now let's go way outside the money. The 465 contracts have a delta of 0.0341 with a premium of 0.03, which comes out to a 113% gain given a $1 move in SPY. Well, obviously, I'm going to choose the significantly outside the money contracts, right? Wrong. Because you're not counting for our biggest enemy as options traders, which is Theta. Theta is the amount that your premiums decay in one day given a constant price of your underlying. So if SPY were to remain steady for the remainder of one day, your premium would decay by this amount. So you are fighting this amount all the time. So 0.87 would become 0.67 because 20 cents for minus 87 would become 0.67 given SPY remain constant. So you're constantly fighting Theta. Now, before you start getting all crazy and excited and going for way outside the money contracts, you have to realize that you are fighting time. And that's what we're going to talk about now is time. And there's two things you need to consider when choosing time: your Theta and your expirations. Those are the other variables you need to consider when choosing which contracts to buy. We've gone over strikes now and how delta affects your bid and the ask. But now we're going to go over your expirations. And you got the expirations right across the top. The longer your expiration, the lower the ratio between delta and premiums and the lower Theta. What is Theta? Theta is the amount that your premium will decrease given a constant price in one day. So if the SPY were to remain constant for an entire day, this premium of 87 would be reduced by 0.2061. So obviously as option traders, we're constantly fighting time. Now let's look at a longer expiration. This is a one-day DTE. This expires tomorrow, one day. DTE of 20. So that's a pretty high ratio for Theta to premiums. So 0.460 on November 1st. Let's look at 460 on November 3rd. 0.20, 0.22, given a $1.85 premium. So right there, the premiums jumped $1 and this only went up 2 cents. So the ratio is getting lower and lower, which means it's going to decay less per day as you get further out in time. So let's go way outside the money. Way outside in expiration. Let's go November 15th, 460s. 0.13 to $4.13. So you can see that's going to be a small proportion of Theta. And those accelerates. The closer you get in expiration, the higher Theta gets in ratio. The more it accelerates, which means your premium decays faster and faster and faster. That is why zero DTE contracts are so dangerous to trade, because if you are wrong, you need to get out of that position very quickly, or otherwise Theta is going to eat your position alive. The chances of that position going back to being profitable because of Theta on a zero DT position, which there's not even one listed right now. Tomorrow, this will be a 0DT position. It's so high that you'll never be able to get your money back. All right, so how do you use this information to start going about picking your strikes and expirations? Well, that's really up to each individual trader. Some traders want to take on more risk, so they'll choose shorter expirations over here, and they'll choose more outside the money. So the riskiest position you could choose is a very short, long outside the money position. So way out here. That's going to be your riskiest position, and that's also going to be the one that's going to hurt you the most if you're wrong. The safest position is a very long expiration with a close at the money or inside the money position, but it's also going to give you your least return given the $1 move in SPY. You have to define your personal level of risk. My personal level of risk has narrowed it down to the $2 to $3 in strike and a 3 to 5 day DTE. So tomorrow is going to be Monday. It's going to be November 1st. So I'm probably going to choose somewhere between the 3rd and the 5th. And then I'm probably going to choose anywhere between the 462 and 463 calls and the 457, 456 puts, somewhere in this range. Now, that's just me personally, and that's over years and years have defined my delta to premium ratio. I'm very happy with that. So when SPY moves $1, I'm very happy with the 20 or 30% I get. And then on the contrary, you have to be able to manage your downside, which is a strong pillar of a mature trader, is accounting for risk and managing your downside. Because on this particular position, a $2 to $3 in strike and a 3 to 5 day DTE, so let's say November 3rd. Let's go look at the number November 5th, for example. This position here, the deltas to premium ratio, I'm able to manage the downside when I'm wrong. When a position goes against me, I don't immediately go red like 30, 40%. If you have a 0 DTE and you're wrong, the position can go to negative 50% pretty dang quick. With these, it takes a while to get to negative 50%. I have to be very, very wrong to get to negative 50%. And most of the time, sometimes, I make a mistake just like everybody. Most of the time, I'm able to exit with a 10 to 15 to 20% loss and manage the downside without completely smoking the position. So with these positions, and people ask me all the time, hey, how'd you choose the position? Why this? Why that? Why $2 to $3 in strike? Why 3 to 5 day dates to expiration? And the only simple answer is because it fits my level of risk tolerance. So anyway, to summarize everything we talked about, if you want to take risk off the table, you go further out in expiration and closer to in the money or possibly in the money on the strikes. And if you want to put on more risk, you go shorter in expiration and you go further outside the money. But also you have to just remember always, whenever you're deciding, it's all about risk and managing for it. And segue, this goes into everything as well, your personal finances as well as all of your investing. If you are not accounting for risk, you are not being a savvy investor or a manager of your finances. Risk always, always, always needs to be accounted for. And through 10 years of grinding that axe, becoming a profitable trader over a decade of trading, I have known to manage the risk. And I've narrowed it all down to my personal level of risk tolerance, which puts me right in the 3 to 5 day DTE and a $2 to $3 in strike. If I see I want to put on a little risk, if I'm feeling frisky and I want to put on some risk, I'll bring it back to a 2 day, sometimes even a 1 day DTE. But you know what I do? I lower my position size. If I'm going to put on risk like that and want a better return, I reduce my position size. And that's going to be a wrap, y'all. Thanks for taking the time to watch this video. If you are new to the channel, please hit that like button and subscribe. You get access to all of my free educational content here on YouTube, as well as the how-to videos that are going to be rolling out here this wintertime. Come join us every Monday, Wednesday, Friday. We stream live for ETF trading from market open until 11 o'clock Eastern every single Monday, Wednesday, Friday. If you'd like to be a part of a great educational resource, a great educational server that's centered around communal learning and constructive ideas instead of play calling and showboating, come over and join the Discord down in the description of this video. Fantastic resource to come together and learn how to make something that's very difficult a little bit easier to learn. Anyway, thank y'all for being here. Until next time, trade smart, be smart, never FOMO.